Will $100 oil wipe out your savings? Oil prices just hit $100 per barrel, and it's not just drivers who should be worried. Investors need to understand how this surge affects their portfolios. In this video, you'll learn what $100 oil means for your investments and how to protect yourself. The recent oil price surge is already affecting the stock market. The S&P 500 has dropped 5% since oil prices started rising, with energy stocks like ExxonMobil and Chevron seeing significant declines. For example, if you had $10,000 invested in ExxonMobil, you'd have lost around $500 in the past month. But it's not all bad news. Some sectors, like renewable energy, are actually benefiting from the oil price hike. Companies like Vestas and Siemens Gamesa are seeing increased demand for their wind turbines, with Vestas' stock price rising 15% in the past quarter. And historically, oil price shocks have led to increased investment in alternative energy sources, with the 1970s oil embargo leading to a surge in solar and wind power research. Additionally, consider the case of BP, which saw its stock price drop by 12% in 2010 due to the Deepwater Horizon oil spill. This event led to increased investment in offshore wind farms, with companies like Ørsted and Equinor becoming major players in the industry. Furthermore, the impact of oil price volatility can be seen in the example of the 2014 oil price crash, where many investors were caught off guard by the ripple effect on non-energy stocks. For instance, the stock price of airline companies like Delta and American Airlines dropped significantly due to increased fuel costs. But the part that surprised me most is what this does to your 401k. That is next. But the part that surprised me most is what this does to your 401k and how it can silently erode your retirement savings. I'll reveal the shocking truth about oil's impact on your 401k in the next section, including a real-life example of how one investor lost thousands due to oil price volatility. You'll also learn how to avoid this common pitfall and protect your retirement nest egg. So, how can you protect your portfolio from the impact of $100 oil? One strategy is to diversify your investments, spreading your risk across different asset classes and sectors. For example, you could invest $5,000 in a mix of stocks, bonds, and commodities, with 20% allocated to energy stocks, 30% to renewable energy, and 50% to bonds. This would give you a more balanced portfolio and reduce your exposure to oil price volatility. Another approach is to consider investing in oil price hedging strategies, such as futures contracts or options. These can help you lock in a fixed price for oil, protecting you from future price increases. But it's essential to understand the risks and costs associated with these strategies, as they can be complex and require significant upfront investment. Back in 2008, during the financial crisis, many investors learned the hard way that diversification is key to surviving market downturns. For instance, a $10,000 investment in a diversified portfolio in 2008 would have lost around 20% of its value, whereas a $10,000 investment in an oil-heavy portfolio would have lost over 40%. And some investors are even looking to alternative assets, like gold or cryptocurrencies, as a hedge against oil price volatility. But is this a smart move? That's what we'll explore next. But is hedging against oil price risk really worth it? The answer might surprise you. That's what we'll explore next, including a detailed analysis of the costs and benefits of hedging strategies and how they can impact your portfolio's performance. You'll also learn about a common misconception that can lead to costly mistakes and how to avoid it. So, what can you do to respond to the $100 oil price surge? Firstly, review your portfolio and assess your exposure to oil price volatility. Consider diversifying your investments and exploring oil price hedging strategies. Secondly, stay informed about market developments and adjust your investment strategy accordingly. For example, if you have a $50,000 portfolio with a 20% allocation to energy stocks, you may want to consider reducing your exposure to 10% to minimize your losses. Additionally, a common misconception is that oil price volatility only affects energy stocks, but in reality, it can have a ripple effect on the entire market. Back in 2014, during the oil price crash, many investors were caught off guard by the impact on their non-energy stocks. By understanding these second-order effects, you can make more informed investment decisions. And finally, consider seeking professional advice from a financial advisor to get personalized guidance on managing your investments. By taking these steps, you can protect your portfolio and ensure you're well-positioned for the future, with a clear plan to navigate the challenges of oil price volatility. Historically, investors who have successfully navigated oil price shocks have been those who have diversified their portfolios and stayed informed about market developments. But remember, this is for education, not financial advice. Talk to a fiduciary for your situation. In conclusion, the $100 oil price surge has significant implications for investors. To recap, the key takeaways are to review your portfolio, diversify your investments, and stay informed about market developments. Take a few minutes to assess your own portfolio's exposure to oil price volatility and make any necessary adjustments to protect your investments. Consider creating a diversified portfolio with a mix of stocks, bonds, and commodities, and explore oil price hedging strategies to minimize your losses. By taking these steps, you can protect your portfolio and ensure you're well-positioned for the future. If this video changed how you think about oil prices, hit subscribe. I break down one of these every week. And as a final step, take action today to protect your investments and secure your financial future.